Hey, yeah, guys, hello, welcome. Thanks for being here. I don't know, I keep getting issues that it's telling me that the stream output is very low, so I'm going to try and see if that gets better. Because I don't want it to buffer and stuff for you guys. But it should be okay, I think. If there are any issues, please let me know in YouTube chat or on the Discord. But yeah, okay, hello, welcome. Firstly, this little banner here on this side is not there. I don't know what happened to it. I didn't fix it, so now you can see my bird cage. Yay! I'll fix it at some other point. Um, what I want to talk about this evening is basically talking about some of the chart patterns and stuff that you have. Sorry, I'm just quickly looking for a document here. Basically, we'll be looking at price patterns this evening. It forms part of like a little toolkit, toolbox, a way of identifying opportunities in the market. It's not necessarily the only way of identifying opportunities, but it adds to that type of stuff that we've looked at. So far we've looked at various momentum indicators and all that kind of stuff. So now we can start adding in price patterns to that, because price patterns basically create high probability opportunities for us to take trades. So before we get to really the crux of the situation, I want to explain a couple of things first. So basically what we have is there are three different types of chart patterns. Trend continuation patterns, trend reversal patterns, and bilateral patterns. So basically what that means is patterns that we can spot that will tend to lead to the trend continuing. So if the trend is bullish and we see a particular pattern, then we should expect the trend to continue to be bullish, or to break out of that pattern bullish or bullishly. And the same goes for if it's a bearish trend. If the trend is down, we see a continuation pattern. We can assume that when we come out of that sort of pattern, that we're going to have a continuation of the trend on to the downside. Then there are trend reversal patterns, of course, which is fairly straightforward. If the trend is up, we see a trend reversal pattern. There is a chance that we may see a trend reversal, and we can expect price to come down off the back of that. And similarly, if price is down and we see a reversal pattern, we should be able to see, we can expect a trend reversal and potential bullish move coming from that. And then bilateral patterns is basically, regardless of whether it's a bull or bear trend, the pattern itself can break both ways. And there are some contradictory type things within that itself. So for example, pennants and triangles, you get a symmetrical triangle and then you get a bullish and a bearish pennant, and in truth they are the same thing. So it is up to you whether you interpret them as bilateral patterns or as trend reversal patterns, as is the case, or trend continuation patterns, sorry, as is the case. So alright, so I want to also just spend some time sort of explaining to you how these patterns are formed. So in essence, I want you to think a little bit about how the market and the hundreds and thousands and millions of people interact with each other every single day in the marketplace. The JSE is obviously not that big, but stuff like the New York Stock Exchange, London Stock Exchange, so on. There are literally millions of market participants that are interacting with each other every single day, and they're interacting with each other around one thing only, and that thing is price. Okay, so it's like a continuous auction that is running, where everybody is competing against one another in order to get the best possible price for whatever it is that they want to do. So if they want to buy stock, they're looking to buy at the best possible price. If they're wanting to sell stock, they're looking to sell at the best possible price to meet their own individual needs, right? So there's competition between people who want to buy and people who want to sell. Now, people buy and sell stocks for a variety of different reasons, and you get a variety of different participants as well. So you get people like us who are, relatively small traders, or in fact, not even relatively small traders, in comparison to the large-scale institutional trade. So there could be funds, hedge funds, unit trusts, institutional, investors. There could be people like investment banks and all sorts of things, all interacting with each other around the same thing. So now let's use an example where a fund wants to buy a particular share, and they have to buy 30 million shares because the fund is really big. They want to take 5%, give 5% asset allocation to particular stock, and that works out for them to be approximately 30 million shares that they have to buy. Now let's say that this particular stock trades about 10 million shares on any given day. That means that this fund now has to buy 3 full trading days worth of volume in order to fill their order. Now you can imagine what's going to happen if they come out guns blazing and they just start buying because they want 3 days worth of volume. They are going to send price skyrocketing. The price will absolutely skyrocket because they're trying to buy 3 times as many shares as what usually trades on a day, and they're trying to fill that order now. So you're going to have a monstrous move and a higher than usual move as well. So that's not really what they want. Their objective is, yes, to be aggressive buyers or whatever. I mean, their objectives obviously can range from a variety of different things, but let's say that their objective is to get the best price possible, which is usually everyone's objective anyway. So they can't push the price up 40%, 30%, 20% in one day because their investment case will no longer make sense at that price is higher than what they're willing to pay for it. So they're now forced to spread out their buying over a number of days, right? So what happens? Okay, 3 days worth of volume is 10 million a day, is 30 million shares is how much they want. But if they do that over 3 days, then they have to buy every single share that anyone is selling. So they have to be the buyer to every seller. So all the 10 million shares they have to absorb in one day, which again, considering that it's a continuous auction on the buy and the sell side of the market, they continuously have to compete with people to be best bid, right? So in other words, that is not going to be a sustainable or a proper way of doing it, because essentially they're also going to push the price up regardless of what happens. This here is an example of the central order book on First Rand for the day, right? This was at some random point during the day, and you can see there are bids and asks. Bid price, ask price. Ask can also be loosely translated as offer. I don't know why platforms say ask. I don't like ask. It's supposed because it's only 3 words rather than offer. I'm used to offer, so bid and offer. In any case, so there's bid volume, there's bid and ask, bid and offer prices, right? And we can see here the best price, highest bid is 61.17, and the lowest offer is 61.19. Okay, and then there's volume on either side. So how this line reads is destination is the JSE. There are 2 orders that total 7,543 shares at the price 61.17. Somebody wants to buy. On the sell side of this equation, somebody wants to sell. 5 individual people want to sell 3,847 shares in total at 61.19. And then as trades go through, it prints on this little tape here, and we can see that the last 20 trades, they populate from the bottom, or they populate from here down. So it would have been, there was a trade at 20, a couple of trades going through at 20, a couple of trades going through, or there was one at 21. Then somebody started pushing it slightly down again. When it's red, the price came down. So we can then see the price sort of started trading 18, 18, 18. Whether that was with offers coming in or bids coming in, or people selling lower, or offers coming in and filling bids. We unfortunately, you'll have to sit and watch and to see, what that interaction is. But the point is that these are 2 opposing forces in the market that are fighting against each other in order to get the best possible price. On the one side, you have sellers who want to get the highest price possible, but also want to sell to people while there are people to buy from them. And on the other side, you have buyers who want to get the lowest possible price, but simultaneously need to buy from sellers while there are sellers around. Okay, so now imagine a situation where you want to buy 30 million of these things. First Round incidentally trades about 5 million shares a day. So let's say you want to buy 30 million of them. You can't go bid for 30 million. You will chase every seller away. You will be forced to buy much, much higher in order to get your stock. So you can't just come out guns blazing and try and buy it all in one go. You have to buy it little bits and pieces over a long period of time, right? So I should probably open that again, just so that there's something there. So basically what you have to do is you kind of have to space out your buy. So back to our example where you want to buy 30 million shares, or the fund wants to buy 30 million shares in a stock that trades 10 million a day. So they can't do it over one day because of this supply-demand dynamic. It will be catastrophic for them. They would shoot the price up way too high. So if they do it over 3 days, well, you have the same problem, kind of, because now you have to, once again, jostle for position to be every purchase for the day. Every trade needs to be used, so that's also not going to work. So they'd probably then spread out their buying activity over, let's say, 10 days. Now, how it generally works is a fund appoints an investment bank or whomever to execute a trade for them. That is then given to a trader who then, you know, in modern times has the opportunity to say, okay, well, I'll pick an algo to execute this order for me, put in the order parameters, and then the algorithm will then execute it according to those parameters. Or, you know, they may choose to execute it themselves manually, depending on the size of the order and the importance of it and the importance of the client and all that kind of stuff. It's a very political world out there. So in any case, what happens... sorry, I'm talking loud, that's why she's making noise. So basically what happens is that this trader or bank or whoever now has to execute the order for their client, okay? And they have, often the client will give them a deadline or a parameter and say you will not pay more than, let's say, 62 Rand a share. And you will deliver my 30 million shares by, 10 days from now. I want the full order and I want 62 Rand and below. For example, that big institutional trader now would go and sit and buy some stock every single day. And he might, say, okay, 62 is the limit price to the up. So I will be patient. I will wait for the market to come down. When the market has come down to a certain point and I can see that the selling has slowed down, I will buy it all the way up to 62, see if I can attract a seller at 62. If a seller arrives, then I will pull back and I will allow the seller to push the price down a little bit, form a dip, and then when I see that there's maybe some volume going through on the sell side and there's maybe some for me to get filled, I'll get aggressive again and I'll buy it all the way back up to 62. And this process may take place over a couple of days. So, for the sake of example, let's say at the same time we have an opposing institution who has an opposing view on our stock and they want to sell the share, and they say that they want to sell, say, 15 million shares at 62 is their limit price. They have a completely different outlook though. They don't have a 2-week time limit on it. They don't mind taking as long as it takes. They want 62 and not a cent less. So the trader that gets appointed to execute that trade puts in an order or basically just waits around until the price gets to 62, and when it gets to 62 he's willing to sell whatever you want. He's there. You want to buy anything at 62, he's there, happy to fill your order. So the price can't get above 62. Now these two sailors on the high seas kind of see each other, right? And they start playing a game. Neither one wants to show their hand. Neither one wants to show how much size they have. Sometimes they might flash a couple of 100,000 shares on the bid or whatever to see if somebody flashes on the other side, and then they can, so it's like poker. In any case, as these two forces interact with each other, we know now, because, well, we don't know this, but because we're making the example, we do. We know that there's more demand than supply. 15 million shares to be purchased, 7 million shares to be sold, right? 30 million shares to be purchased, 15 million shares to be sold. Although at the time in the market doesn't know this. So the buyer is basically allowing price to come down, and then you'll aggressively buy it up, and then he sees, oh, at 62 there's a seller. He'll print some volume there and see, okay, this guy's not going anywhere, so he will take his foot off the gas and wonder if the seller will chase him lower. So he'll take his foot off the gas and allow the share the price to drift down again. The seller, on the other hand, is very patient. He's not doing anything. So Mr. Buyer Man comes back and pushes up again and hits up into 62 again, does some volume there, decides, no, let's go. And so we have the price sort of moving higher, hitting a level, coming down, forming a new low, or forming a low. Moving higher, hitting a level, coming down, forming another low, but this time there's less selling pressure, so the low is lower before the buyer steps back in, because the buyer has a timeline. He's got to get this done by 2 weeks from now, and he's testing this guy a little bit every second day, and it's not exactly getting enough volume done. So he needs to increase the speed a little bit, so he doesn't let it fall as fast before he starts buying again. And all the time through this process, the daily volume that's being traded is increasing slightly as the buyer is getting more and more aggressive into the seller. Eventually, the seller runs out of steam. Okay, he's now sold all he's had to sell. The buyer has accumulated up to this point, let's say 25 million shares of the 30 million that he needs, and the buyer has sold all 15 million. And the other 10 million that the guy would have gotten, or the buyer would have gotten, would have been in this process of allowing it to drift down and buying it back up, right? So the last 5 million shares he's got to accumulate. He's now got a day left or 2 days left. The majority of the stock he's got under 62, so his volume weighted average price is say 61.80 or 61.75. So the last 5 million shares he can really buy at a higher price. It doesn't really matter because his average price on the entire trade is still going to be 62, and the seller has disappeared. He pushes up to 62 and there's nobody. There's no big volume seller coming in, and he's got like a day left or 2 days left, and he's got to buy, and he's now out of time, so he starts pressing, and he takes those last 5 million shares in the 2 days. And that is basically how an entire pattern has formed and broken out. So to show you what that pattern would look like, it would be this pattern. All right, an ascending triangle. So the point here is, behind that incredibly long story, is that every single price pattern has some sort of a reason why it is being created. There is a interaction between buyers and sellers on a scale bigger than we can imagine that is forming these patterns, because that's just two fund managers making decisions based on what they believe is expensive or cheap. All right. It could be a huge family trust getting out because the person died and the inheritance needs to be paid out. It could be an amalgamation of millions of traders following the momentum and the trend, pushing a stock into a certain direction. There are so many variables that these forces are it's almost impossible to tell what's really. There's not just one driving force. There are multiples of driving forces all acting on this thing at the same time. But in the end of the day, these patterns do emerge because we have, those forces. We've got things like herd mentality. We've got people who are just kind of following the trend. We've got big institutional players who actually physically have the ability to move the market because they're working with billions and billions of rands and dollars. So the scale at which this happens is really absolutely colossal. And that is what the patterns help us to identify. We can see from the different patterns basically what the sentiment or the mood of the market is towards something. And from these patterns, based on sort of just thinking out the psychology behind them or what potentially could be happening behind the formation of this pattern, we can make some sort of probabilistic forecast on what should happen if the pattern breaks or if the pattern plays out or whatever the case is. So I'm going to try and attempt to show you some of the thinking behind how some of these patterns are formed. But it is important to note that these are probabilistic forecasts only and not guaranteed, okay? Because they are technical stuff that are based on people interacting with each other, and they're backward looking. We don't know what people are going to do tomorrow or the next day or right now even. So it's difficult to say that we can use these things to forecast 100% of the time what's going to happen. We can say that they have a reasonable rate of success that's higher than 50-50, and that's why we track them. And we only need 50-50 odds if we have proper risk management in place, right? That's trading. Sorry, let's check for questions. None so far. None on the Discord either. All right, great stuff. Also, a couple of things that I'm going to point out a few times throughout the course of this, but I want to sort of get out the way now, is the largest move within the formation, which is usually the first move in the formation, is the move that you use to measure your price target coming out the other side of the formation. And it is very usual for formations to break, retest, and then continue going. So you could have a triangle breaking out, a retest of that level, and then a continuation. That is very, very often the case. So the lines and stuff that I've drawn here are sort of simplifications. Within them, there may be more moves than what is shown. So we're going to start with the first type, trend continuation. And with that, I'm going to continue to drink my coffee that I started a little early. And I keep the teaspoon in. I don't know if anybody cares about that, but I do. Right, so trend continuation pattern. The first one is a bearish pennant. Okay, so what we can see here, sorry, the screen of the camera is there, and the screen I'm looking at is there. So if I don't look at you, it's not personal. You're all beautiful. In any case, so trend continuation pattern is a bearish pennant. So we have a move down, and it forms this sort of symmetrical triangle situation with the price bouncing between two levels. Okay, when we break out the bottom of this, we could target this distance here, basically. This first impulse move here is the target to the outside, and the stop loss would be on the extreme. Some people would put the stop loss in the middle to be like ultra safe, and often they do that because they want to kind of manipulate the risk reward of the trade in order to work. But the most safest way of trading it without giving the trade the time and the space it needs to work would be to put your stop loss sort of at the I'll call it a consolidation extreme. In this case, it's not quite, because we have a tightening consolidation here, but at the sort of most recent high. So we can say that if it takes out this high, then maybe there's a chance it made a fake breakout to the bottom and it's actually breaking out to the top. Now, this is a bearish pennant, yes, but later on we'll see also that is also a symmetrical triangle. So it is a bit of a conundrum. These pennants and triangles are actually bilateral, but they can act in two different ways, which is trend continuation as well as bilateral, right? So they can be trend continuation or reversal is the point. So the basic thinking here is that you just have two basic opposing forces that are getting more and more and more eager to get out of the stock. You may see volume increasing throughout the course of this. Then you would have like a squeeze on two opposing forces, and then it'll pop out one of the sides on sort of a high volume break. What's important is that when it breaks out, it's followed with volume, that there's a lot of volume that gets done in the hour or 2 hours or whatever time frame it is that you're watching when the thing breaks out. Bearish rectangle. So basically what's happening here is price moves into a range. So we've spoken about range trading a bit. You wait for consolidations around the edges of the range to trade them, to trade within the range. But to give the thinking of the range is that, like I explained, that scenario where you have one more aggressive buyer and one more sort of passive or patient seller. In this case, you have two patient participants. You have a patient buyer and a patient seller, and this guy's sitting here and he's defending his line, and that guy's sitting there and he's defending his line, or they could be women, who knows. they're just basically sitting there, well, this is my line in the sand and I shall not pass. And you have this consolidation between those two extremes, and the market will eventually break one or two, or one or the other. They might even battle each other, and over time, it might start off as a rectangle and then end up as a triangle as these two forces push closer and closer and closer together, right? Often volume will also increase in here, but this is basically just a range trade. If you have a nice, beautiful range like this, where it's just going sideways for some time, then it means that the buyer and seller might probe each other every now and then, and that's how you see the movement between the two levels. But the majority of their volume they want to do at their particular level, and they just wait it out until one of them drops. The market will naturally bounce between the two extremes, or between the two, between the buyer and seller, and eventually one of them will break. Again, there will be a high volume situation, because when that thing breaks, suddenly the seller is going to realize, oh my goodness, the buyer is not around anymore, I need to get out. And then he'll start, or she will start pushing it down, right? So that is a trend continuation bearish rectangle. So a downward movement into the consolidation and a downward movement out. So entry obviously on the break of the trend, or on the retest of the trend, and the stop loss is actually the same way we would trade any other range, which is halfway between the range, and the target here is the range distance, right? So that distance there is the same as that distance there, or the distance between the high and the low of this range, and stop loss in the middle, easy peasy. Just want to see what's going on. Oh, right, okay. I thought I was getting messages, but no messages for me. All right, moving on. Then another trend continuation is a rising wedge. So we're starting with all the bearish trend continuations. I wonder if I'm bearish or not. In any case, so a trend continuation here is a rising wedge. So price moves down into the wedge, and then we have sort of a tightening pattern where we see consecutive higher highs and consecutive higher lows, but we have this sort of like the slope of the higher highs is sharper than the slope of the oh man, that gets so confusing. The slope of the higher lows is a higher angle than the slope of the higher highs. Wow, you can see the picture, it's pretty easy. Again, some people would put the stop loss sort of in the middle here, because they try to kind of squeegee the risk reward ratio. But you would measure this move here. This is your first, so this is your move into the thing. This is your first move in the formation. So you would measure that movement there, and you would project that out. And then I would put my stop loss above the most recent high within the formation after it's broken out. Right? Pretty straightforward, I think. You can see now that's a message. Then we have a trend continuation, which is once again a bullish pennant, or once again a pennant formation or a symmetrical triangle, and this time it's a bullish pennant, and we know pretty much straightforward what the situation is here. Entry, target, stop, we're measuring that move there. Sorry, I'm lying, that move there, that's our first move inside the formation, is our target move out. Alright, stop again below that. Once again, people might put the stop sort of in the middle between these two, but I would rather put it at that low. It just increases the probability, because you could have a fake move out, or a retest down to sort of this low and then go. These things are, the way that they're drawn and the way that you see them in textbooks and stuff is kind of the ideal self rather than the actual self, right? So they don't necessarily, sometimes they get a bit messier than that. Then you have, again, a bullish rectangle, so it is the opposite of the bearish rectangle. In this case, the market moves up, consolidates, breaks higher, and we have a similar situation with the falling wedge, which is the market moves up into a wedge formation. Hey man, I didn't connect those dots nicely. There you go. Into a wedge formation, and then it breaks out, and once again, you're targeting that move there as your price target outside of that. Then with all of these types of things with these trend continuation moves. Okay, what I would what I would think is relatively important is that you have in the triangle setups, it's a bit difficult to tell, right? Because there's no real counter trend movement, as well as in the rectangular type movements. There's no real counter trend movement. There's a bit of sidewaysness. So here, what is important for us to look out for is big volume on the breakouts, right? If we get breakouts here, we want big volume on those breakouts. With the wedge formations, what is quite important is to watch volume throughout the formation and to see what volume's reaction is doing. Because remember, if we spoke about the on-balance volume indicator and how volume either confirms or denies a trend, or confirms or doesn't deny, but I mean it can confirm or not confirm a trend, right? So you would want to see volume while this consolidation is happening, this rising wedge is being made. You would like to see volume taper off, become less and less and less as price is rising, and then kind of burst the dam walls and increase quite rapidly or increase quite high when this break happens. And the same with this. Volume it has to be a confirmed trend, increasing into the higher prices. Then as we start getting this consolidation and this falling wedge, we see a tapering off of volume, and then a high volume burst of break of this consolidation. That is kind of what we're looking for, and I think that's important to take note of, because a lot of the time we see just the formation, we think, oh, this must be it, but we have to consider volume in all these things. Again, like the pennants and the rectangular stuff is a bit more difficult. The wedgie type counter trend formations is usually a lot easier. And that covers the trend continuation stuff. Have you guys got any questions? I don't know, I sounded a bit like an Australian there for just a moment. But it seems not, because the stuff is fairly easy. Okay. Then we have trend reversal patterns, and we're going to start with the falling wedge. So once again, what is important here is we would like to see a build up of volume during this thing. This is basically an accumulation pattern. So as we get closer and closer to the sort of meeting point of this wedge, we want to see volume increase, and then break out, because we have it's not quite a counter trend movement, but this trend is now reached its end. So volume would have been increasing here, then it might decrease a little bit, but as we get to the close to this end here, we want to see a build up of volume and a breakout. Or what more likely would have happened is that volume may have reduced into the dying sort of ends of this trend. So remember, because volume would have, if the trend was really going to continue, it would increase here, decrease here, increase out again. So what we would have seen is an decreasing in volume, then an increasing during this reversal pattern, then a breakout, if that makes sense, right? So once again, we measure that move. That is our height on the target out, stop loss below the lowest low of the formation. Where are we? Then inverse head and shoulders. This is probably the most well-known one. What is important here is, once again, volume is very important to watch. Volume has to be the highest on the right shoulder of the head and shoulders always, whether it's inverse or normal head and shoulders. You kind of want to see volume taper down and increase slowly over this period, and then really bust through the dam wall when this breakout comes. And what you do here is you measure the tip of the neckline, the tip of the head to the neckline, and you forecast that out as your target for the formation. Then there's a double bottom. Double bottom, double tops are actually pretty cool. What you do is you measure the lows, so it would have made a double bottom to the sort of neckline of this thing, so to the high. That distance you measure out, and that's your double bottom target. So I'm going to just quickly skip to something here, just to give you some of that. Oh my goodness, he can't be serious. stuff. You know what? Make it that because it's nice. And then let me show you. No. Yeah. Oh. All right. Look at this. Look at this. Look at this. Look at this. Let's make it red. Let's make it big. Oh wow. Okay. My fancy area chart is not working. Let's go bars. This, dear friends, is a double bottom. There's a bottom. There's a bottom. This is the tip between the two, right? That says 72, 73, well, 72.50, and that says 7 at the bottom. So we have basically a 65 Rand price target above 72.50. This is a Banya Gold. That's a rounding bottom as well. Ironically, not one of the formations that we cover, but double bottom, it could potentially be a massive thing. I know it doesn't come in from a live trend, but it wasn't listed before this. So yeah, that's a weekly chart. I mean, it's going to take years to play out if it's right, but it's something worth looking at. In any case, so that neckline between the two extremes here, or between the two bottoms, is basically what our how you measure your target, and you project that out. Then the same with the rising wedge, or not the same with the rising wedge, but the rising wedge is a very nice bearish reversal pattern, if you want to call it that. Volume would have started tapering out on the. Oh no! All right, okay, we're back. Sorry about that. You know, ever since load shedding, my internet has been unstable, and I think what happens is I think it's out there in the world where things happen and the internet is just unstable, or I don't know, servers go down, routers, switches, whatever. I don't know exactly what it is, but my internet's been terribly unstable over the last couple of weeks, and it has been ever since load shedding started. I'm very lucky. I'm situated in an area where there is no load shedding. But my internet isn't stable, which is annoying. In any case, all right. So looking at the rising wedge, what would have happened here in this situation, and with other sort of wedge situations as well, is that the main trend has now sort of come to an end. Okay, so trends are driven by this institutional strength. Or institutional interest in a stock. So institutions will buy, the banks, the funds, the big multinational corporations, whatever, the smart money, the big money, the whales, would push a stock and push a stock and push a stock for a period of time. And eventually they run out of ammo, but now they've created a ton of momentum. And then people who are smaller traders, individuals, smaller hedge funds, whatever, are following this momentum and buying into it, but they don't have enough ammunition to really push and push and push this trend as much as what they would have. I don't know how much of this, I see that it's buffering. I don't know how much of this is even working. Actually, you know what, I'm going to refresh that. Let us see. No. Yes. Oh, stream is live. Alright guys, I don't know where you lost me. This is irritating. Maybe I'm starting to consider maybe I shouldn't do these live. Maybe I should make the videos, then I can drop this little boxy thing as well and put them up. It's a lot more boring though, because then I can't interact with you guys. And I quite like the fact that you can ask questions and I can explain stuff and whatever. It's a lot less formal, if that makes sense, and I don't like being, well, hello, we are discussing this stuff today, and the truth is, people are people, and They don't like suits. Well, I don't like suits, and that's why I want to do this. So anyway, okay. So basically what happens here is the market trends up for a protracted period of time, as fueled by big institutional players, right? That's what we were saying. Eventually, those big institutional players have now run out of steam or changed their minds or whatever the case is, stopped buying. And the only people that are left are the smaller participants, which is us, and the smaller, well, not even us, like, we're the tiny participants. I'm talking about smaller funds, smaller hedge funds, whatever. And they kind of chasing the momentum that was created by the big institutions, or the simultaneous shifting of sentiment into something. And everybody kind of, this massive buying power starts to fade away. But you still have higher highs being made, but every high is being made on sort of lower volume, and you start seeing higher volume trading down. And then every high again is starting to be made on lower volume, and then there's higher volume trading down. So at this point, your on-balance volume indicator starts to diverge, right? Because now there's a pickup in volume, but that volume is being traded when the stock is these correction waves that the stock is making. In these correction waves, you have higher and higher volume, while here you have lower and lower volume. So this is now a situation where the mom and pop traders, as we call them, are starting to get long because they're chasing momentum, and they all heard, wow, these cannabis stocks, or wow, these platinum stocks, or whatever the case is, are so amazing. They've made all these people, if only I bought some 4 years ago or 2 years ago, I would have been a gazillionaire by now, and I'm gonna throw in everything I've got right now. And they're buying in this situation, while the smart money has started selling because they've realized that, hey, we had a price target, we're pretty close to that price target, so every time it starts showing a bit of, if it continues to show strength, we're going to sell into that. And then you have the formation of this thing. So you've got retail traders trading it up on low volume, you've got institutional traders dumping it down on big volume, and you have this little bit of battle that lasts for a couple of weeks, or a couple of days, a couple of hours, whatever it is, and out she comes. Once again, the safest way, so this is a trend reversal pattern, as are all of these, right? So yes, you can potentially look for the trend to reverse and continue to reverse in the opposite direction, but for the purposes of this individual formation, you want to have a trade that you can get in and out of, right? If we are trading, we are not getting married to positions. We don't have to be in a trade forever in order to prove that we got it right. Okay, what we need to do is make money, and that means that at some point you've got to get out and you have to take your profit. Okay, so that is what we have to do. Therefore, again, we measure this first sort of impulse move, or the first move inside this consolidation, or this rising wedge, and we project that out and we say bang. That's it. At that point we'll take our money, because from there it might form a new pattern, or the price might come all the way back down here, but then we can employ other methodologies to potentially get involved in that. And also, we don't have to catch every move, right? They're not Pokemon. We can't catch them all, and we certainly don't want to be taking on excess risk when we are short-term participants in the market. Nonetheless, these could be great opportunities to show change of direction, or whatever the case. If you're a long-term investor, maybe you see a head and shoulders pattern on a stock, and you think, well, this is it, I need to get out. Or you see a inverse head and shoulders on a stock, and you think, well, this is it, I need to get in and stay in for the next 10 years. So it's important to note that you're not the only people looking at these things. The big fund managers look at them too, often because they make them, they form them, not out of choice, but just because that's how it plays out, right? Then of course there's the head and shoulders pattern. Important that during this right shoulder you have high volume. Again, the volume needs to pick up on the down movements rather than the up movements, so on-balance volume is relatively important in this situation. Once again, you measure the tip of the head to the base of the neckline, and you project that out as your target price. Double top, same story as a double bottom. Between the two tops, it would have like a like a midpoint or like a neck, or like an extreme, so you call that the neckline. You measure neckline to this area here, and you project that out, and you have your target for your double top formation. So those are all reversal patterns. Then there's our two more, well, one really, which is a trend reversal pattern. It can work in two directions. It is a megaphone pattern or a broadening pattern. This is actually one of the cooler ones out there. There was a great example on this actually. Let me show you. Okay, I'll show you some examples here. Aspen, hoe kom is je start so kort? So this is the Aspen chart, right? Pow, over a couple of years, and I mean decimation, complete and utter destruction of. I almost said a bad word, but if you look a little more closely, I gotta zoom out like a monster. This is a head and shoulders. Okay, so you would mark it shoulder. Oi, we want it to be pink. Man, come on. I don't know. There we go. And there's another shoulder. And this is a head. Right? So they get, this is called a complex shoulder, so that does count as the right shoulder. The stop loss is there, remember, as per our little sheet. Let's go back to our sheet. Our sheet is there, so the stop loss is above that high. So we are going to look at this high here. And maybe it'll be easier if I make this a line chart, eh? I've got that horsey who comes to start so quickly in my head. It's bad. Alright, so shoulder, head, shoulder. That does look very difficult to see now. There. Okay. What you need to do is you need to identify the neckline. So we need to take a normal trend line. We need to cut that to there. Alright, for the sake of simplicity, we're just going to put it like that. Bang. Alright, so there we have a head and shoulder formation, right? So upon that, you can potentially see, now there's these giant volume spikes, which is going to obstruct our on-balance volume, OBV. Right. OBV. It's going to mess with our OBV indicator here, most sadly. But let's make this white as well, I suppose. So we can see here during our right shoulder, in the end we have a tapering of volume coming down, right? As this is going down. Then we have a break, kind of retest. It doesn't quite take out our stop loss because our stop loss is now here, right? Doesn't quite take out our stop loss. And volume is still kind of trending down on the down days. So we have bigger volume being traded on the down days, and we just see this thing. So let's measure where it would, let's project and measure where it was going to target. We are going to take that is 20%, that is 20%. Alright, so this is obviously not how you use this buy sell thing, but whatever. So let's mark our level is there, bang. And then you would actually take this trade. Click. Wait, it's not a long position. You got to actually select short position. So you would put that trade on, right? So you are risking 8% to make 20%, so you got a better than 1 to 2 risk reward ratio, and boom. At that point, I thought I'd pulled off the best trade I'd ever pulled off. Okay, I actually shorted it here, if I'm not mistaken, because I saw this thing forming, and when this sort of upward little correction wave broke, I shorted this thing here. And I thought at this point, I was like, wow, this is the best trade I've ever done in my entire life. But unfortunately, as we can see, I was very, very wrong, because that head and shoulders pattern turned out to be absolutely terminal. Ironically, there's an inverse head and shoulders. That's the shoulder, or that one, or you can sort of group them together and say that's the shoulder, that's the shoulder. And we are stop lossing there on this one. We have an on-balance volume indicator increasing into the thing. Yes, so our volume is increasing in direction of trend, which is fantastic. It's what we're looking for. I'm going to just remove this annotation, and I'm going to copy you. Oi, oi, shoulder, come here, head, and shoulder. Right. We're once again going to draw the neckline. Alright, and we're going to enter into a, let's just measure this. Oh wow, that targets all the way at the top. Right? And we can see it didn't actually even make it. So you would have actually taken this trade and you would have gotten stopped. So your long position would be that to there. That would be your trade. Unfortunately, that one didn't work out so well. Our head and shoulders here just was too powerful. This is valid. So what is important? People want to find head and shoulders like everywhere, okay? You have to make sure that when you are, there are two things that are needed for head and shoulders. If the head and shoulders is at the top, like a normal head and shoulders is a bearish reversal pattern, it must be at the top of a uptrend. Can't be in the middle of a consolidation. It doesn't count, okay? And if it's an inverse head and shoulders, it must be at the bottom of a downtrend. It can't be in the middle of a consolidation. It doesn't count, okay? So this one worked. Unfortunately, it didn't play out to target. You could have used the trailing stop, so you still would have been mostly safe. But on the break of that, break retest actually, you could have gotten in here. I don't know how this trade would have fared out. It's not one that I did. I remember this one very clearly because it was one of the bigger trades that I've ever done. In any case, okay, so we follow, and I mean, we all know the story. It comes down, right? So, and this head and shoulders top was the forewarning for the long-term investors. Unfortunately, this sucked you in. It wasn't quite the end, but it did stop you out. And if you look at, you know, what the longer-term picture is, it saved you a lot of pain as well, right? Questions, guys. Let's move to the left screen. All right, okay. So head and shoulders, important. Volume must increase in the direction that of the breakout, aka if it's a normal head and shoulders, volume has to increase on the downside. If it's an inverse head and shoulders, volume has to increase on the upside. So you're watching that on balance volume indicator with these patterns, right? Essentially, with the trend reversal stuff you're looking for, signs that there is divergence between OBV and trend. That's what you're looking for. Okay, double top we've spoken about. Then the broadening pattern, this is another one. Oh yeah, this is actually the example that I wanted to show you. And then I got sidetracked into good old Aspen. So this is also a long time ago. But if I remember correctly, I'm not sure. This is also daily. Yeah, I remember this. go that way just yet. I think that's what I had drawn in at the time. So that was like the warning shot, you know, that we have potentially a reversal. And if we look at OBV, we can see here OBV is always just bullish, 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 bullish all the way. But we now have basically a higher, we have a high here, so we have this beautiful uptrend here, and we have, then it makes a lower low, but it doesn't take out that low, so it doesn't really bother us, and it makes another high high, and it makes another lower low. So now we're going, wait a minute, this is basically just Dow theory making a new low, right? And we can see here that volume is now starting to trend very slightly down, more volume on the downside. And then that was just basically a reversal pattern of the ages, you know, in context, that's what it looks like. Whether or not I used that correctly, I don't know, but I remember I had that chart drawn in ages ago, but I didn't trade it and whatever, so I suppose it doesn't really count. Anyway, alright, so broadening pattern. Similar kind of situation on it's a trend reversal signal, and the opposite of that looks like that. What is nice here is you can put your stop loss in the middle between the two sort of trends, if you want to call them that, trend lines, and then you can do your stop loss once again. So remember what I mentioned here was that the largest, and I said first in brackets, is the price target move out here. In the broadening pattern case, it is not. It is the last move and or last or biggest. You know, the largest or last move of the broadening pattern is the biggest. Using coronation as our example, that would be, where is my measuring tool? Measuring tool, measuring tool, oh measuring tool, oh measuring tool. So your price target would be like there, right? Which is pretty close. I mean, it came just a little bit over that actually, and well, recently a lot more. But that would have been a fairly decent trade if you had the patience for it. These are a bit harder to really truly find entries for. I'll be honest, because you kind of like looking at this thing and you're thinking it's going to be support, it's going to be support, and how do you know if it's really broken it and whatever the case is. But I guess what you really sort of want is like a move below, sorry, let me just make it bigger, like a move below, and you can see here, this is a daily chart, it really kind of consolidated around this period for a couple of days. I'll put candles on. It really consolidated around this level for a couple of days and then broke it, retested it, broke it, retested it again with the hammer or inverse hammer shooting star formation, and then schmelt. I mean, that was pretty good. It actually came back down to test it again, but no, this was our move to target was in this move here. Yeah. So you had a couple of chances to get this. So remember, like I said, with these formations, you don't necessarily have it's not as clear cut as this, right? You've got to use discretion and all sorts of stuff. And that brings us to bilateral patterns. So now, you see, this is where I have a bit of a disagreement with the stuff that I'd learned right in the beginning. So I always believed that these rising or these flat top and flat bottom triangles were trend continuation signals. But they're not, apparently. The more I kind of like studied up on this stuff, because I did go on a bit of a study quest to learn as much as I could about technical analysis, and these are technically bilateral formations, and if I think about it now, I have seen them fake out of the one side and break in the opposite direction a few times, but I've also seen them follow through and be trend continuation patterns. So they are pretty much like 50-50 which way it's going to break, and in this case you just have to be patient with them and allow the market to decide and dictate which way it's going to go. Again, obviously watch OBV. You want to see volume increasing in the direction of the break, and that's kind of going to be your forewarning here. And you may want to switch down to like an hourly chart or whatever the case is to try and figure out what that OBV is doing on balance volume. That is. So yes, again, this move, this first sort of consolidate, or this first move within the consolidation, the biggest move is our target either out or in. I mean, either up or down when it comes out. And you want to basically put your stop loss at the opposite end. So where this entry is would be the stop loss for the long, and where this entry is would be the stop loss for the short. And yeah, basically the same thing with the ascending triangle. This is ironically the situation or the scenario that I spoke to like in the intro of this is basically, and I mean, let's be honest, it's a scenario. It's one of a million types of scenarios that could lead to this formation. It is not the only such a scenario that would lead to this formation. It is one of the like many different types of scenarios that could lead to this particular formation. And then lastly, you have another bilateral pattern, which is a symmetrical triangle, which means it can go like both ways, right? It can be bullish or bearish. But now, again, back to what we said in the beginning, where there's a bit of confusion around what is the continuation versus bilateral. So basically what it comes down to is don't trust triangles. They can break in either direction, whether they be flat top, flat bottom, or pennants. Pennants are basically symmetrical triangles. It depends on if they turn out to be a continuation, a trend continuation signal, then they're a pennant. If they turn out to be trend reversal, then they turn out to be a symmetrical triangle, I guess, is the classification. So I wouldn't place too much trust in them, but they are helpful to know how to trade. Absolutely helpful to know how to trade, because they also do tend to work. Most of these formations, the head and shoulders is the most reliable as such, but even so, it only has like an 80% chance of success. Okay, and just because it's got an 80% chance of success doesn't mean that it's going to work every time, right? That's not how probability works. Probability says yes, there is a 80% or 81% likelihood that this is going to work out in this thing, but there is also a 19% likelihood that it is not going to work out that way. So they don't always work. Most of these guys, I mean, some of them have, I don't know the exact stats on them, but they definitely are all over 50-50, otherwise we wouldn't use them, right? So most of them are sitting at around 60%, 75% likelihood of being an accurate forecast of what price might do in future. But again, it's not necessarily indicative of, it's like not a guarantee. Then yeah, let's look at some of your charts. It is time. It is about that time. We have here, I'm just gonna save the original because I know you send big charts. I'm gonna open all of them, and I'm gonna say rock and roll, baby. Okay, view original, and view original. Alright, first one. This is from Peter in Discord. Thank you for that. They're all from Peter in Discord, actually. Triangle continuation pattern. Yes, that might be it. What are we looking at? USD ZAR daily indicator. Did I or did I not close that trading platform? I closed it, so I'm going to open it in the meantime. Yeah, okay. So what we have here is a flag formation, actually, which is one of the formations that I didn't cover. Basically, you have a price movement up into a like a channel line that comes down and forms a flag. So imagine a flagpole and then a flag. What you could do here is a couple of different ways of trading this. There's the safe way, there's the aggressive way. Okay, this should be an equidistant channel basically, and you can measure the distance of this channel. You trade it like a normal channel breakout or like a rectangle breakout. You measure the distance of the channel and you project that out as your thing, and your stop loss would be halfway in the channel. Okay, you can add a third channel line in here and you'll see that it'll somehow, with magic, kind of, that would be support, that would be resistance, and it would kind of work out like that. I just want to see if I can just give me a sec. In the yellow submarine. Yeah. And I'm bullish again. Alright. Bang. That's the S&P 500 1 hour. Bit of a fake breakout and a explosion higher, which is great. This level that I've got drawn in here is basically just a fancy schmancy resistance level. But alright, what are we looking at here? We are looking at the USD ZAR. USD ZAR. Oh. USD ZAR. Daily chart. I'll give you a daily chart. Load, damn it. Alright. So you have drawn in here. Oh wow, you're looking at like a ton of data. Oh no. You're just looking at that. Okay. I'm gonna take you away. We're gonna take you away. We're gonna take you away. So you'll have this. Am I drawing the same chart here? Our charts do look different. Am I looking at the same time frame? 20 March, 14 Feb. Alright. I think I'm looking at August last year. Yeah. Alright, so I'm drawing my chart slightly differently. But yeah, actually, so to show you that little thing, what I'm going to do is I'm going to move to a 1 hour chart. And then see if we can find your triangle on the 1 hour, because it looks to me like it's breaking down. Looks to me like she's breaking down. She's breaking down low. I should get their permission. I can use their music. Crimson House, they're really cool. They no longer make music, sadly, but they were really cool. I've made a mistake. I've made a huge mistake. I said load a year's worth of hourly data, and I'm using all my brain power to stream. Give me 3 months. Go. In any case, so yeah, this is a valid formation. It could potentially, what I was going to say here is it could potentially walk this line for a while. So knowing now that the price has come down somewhat, I'd expect it to maybe find a bit of support here around this red line that you have drawn in here. Wait for breakout of triangle, it's bullish. So yeah, so the triangle is bullish, potentially. It may not be. Also, I would argue that if you're going to draw the triangle this small on a daily chart, it would be best to draw it on a shorter time frame, like a 1 hour chart perhaps. Oh my goodness, what do we have here? Alright, there's our level. Okay, let's have a look. Alright, so here's our sort of trend line level. It's not perfect, but it's there. So this is your triangle here, basically. Wait. Mustn't. Alright, okay, so that's basically your triangle there. For sake of ease, I'm going to make it nice and big. Wow. They don't mess around with this 8-point line, eh? Bang. And it appears that that one has broken down, good sir. So I guess that goes to show that triangles are, in fact, bilateral. because if we were to follow our symmetrical triangle situation here, that could break in either ways, or our pennant situation would be a bullish pennant, and this was definitely not a bullish pennant, right? So interesting. What is nice is you've got that support level at what is that, 1432-ish. I would argue that 1419 is maybe a bit low, so maybe 1420, wherever this like pink line comes in, would be the next support level. Well, 1419. Hey, actually, look where we're trading. On this side, we're trading 1418. So this might be. Let's have a look to see if I'm going to just remove this line because it is annoying. Let's see if we have Viva la Resistance. Alright, so let's actually do this the old school way. There is resistance. We're gonna go look. We're going hunting for resistance levels. So that is confirmed resistance. That is confirmed resistance. That is confirmed resistance. That is confirmed resistance. I'm using the not the Gann 2-day method. What's the other one? The Williams or DeMark method, or whatever it's called. That is confirmed resistance. That is not. That is. Alright, so that gives us a bit of a big range. Let's eliminate that one. We'll include all of these. And we'll put our zone here, which gives us a 10-cent range, which is pretty huge. That's a huge range. So we said 10-cent range, eh? So this is kind of like the support area that it is in now. It has to find support here and turn, otherwise the fat lady might be singing for this little trend here. But if we look at something else, we measure our big move in, right, and we measure our big move out. We're looking at a price target here of 1405, which is through the resistance. Viva la resistance. So that would be the price target for this move at the moment. So we would have to break this resistance. What happens then, I don't know. But judging by the volatility of this thing, this may not be like an actual trend change. It could find a bottom here, and that would still be a higher low. So there might still be weakening on the cards, but short-term strength. Something obviously happened in the US, because we have a hell of a US 500 move as well, or S&P 500 move. So there's obviously some sort of a catalyst in the market, and hey, catalysts just sometimes just so happen to break formations on charts and stuff. But okie dokie, let us go. USD did not trade, but went more probability on trend. Yeah. So these things are just examples. We are. I'm kind of glad you didn't trade, and even if you did, it was a valid trade. And as long as you stick to the rules, right? Coffee time. Okay, the next one. What do we have? USD MXN. I don't know if this is available on this platform. MXN. There it are. Okay, bearish flag. Right, so I maybe should have done flag formations, right? Bearish flag formation. This one I quite like. So again, two ways of trading this flag formation thing. And I didn't actually cover this in my little beautifully drawn thingies, and now I feel kind of silly for not doing it. But you can measure this. These are two you know, what do you call them, equidistant channels, right? I'm just going to replicate his chart in the meantime, daily, and give me 20 years, baby. Okay. Right, okay, so I'm just going to switch over to mine. So you can basically draw, give me a trend line. Give me that trend line, baby. I would use, alright, so pro tip, you have to be consistent with your approach to how you connect tops. If you're going to use real bodies on candles, use real bodies on candles. If you're going to use wicks and tails, use wicks and tails. Don't use real bodies on the one side and wicks and tails on the other side. That is not allowed. Bang. You see. So it would actually work better if you use the real bodies here. Which means, okay, if you're going to use that real body, so I'm using the real the open on this candle as my low. I'll just show you the open on this candle, because it's the one that's nicely in line, right? And then I have to use the close on this candle because it is the highest in the range as where it intersects with my line, and that's my range, right? And then what I can do is I could probably clone this and stick it in the middle, and oh my goodness, what do you know, here we have, it's a little messy, but we have like a real let's make them, I always like pink because it stands out, it's easy to see with these backgrounds. And there we have a nice easy to see with these backgrounds, he says, and he puts the thinnest line known to humanity. Is that better? No, still not. Is that better? He says. So now you see how that kind of you can see, like, there's a whole theory behind this, and maybe this is a thing for another day, but you can see how that is support here, it's resistance here, it's resistance, it's a bit of support. So like there's an interaction of this midpoint of this channel, right? So you have this move down into the bull flag, onto the bear flag, sorry, and then a break out of the bear flag. It's a beautiful setup. So I completely agree with this setup that the target price is here. So now there's two ways that you can do this. You can measure this equidistant consolidation or flag, and you can call that your price target out. So if we do that, you have to measure that piece there, boop, boop, and then target that out, and then you can see that we've reached target already. Okay. The other way of doing this is by looking at this entire flag pole into the flag formation and then projecting that out. Okay, so that would be looking at this whole flag pole. So we're going to basically measure from there to there. All right, that is a huge move. And then because we're measuring to the bottom of the channel, we have to start at the top of the channel, right? So we then go from there to there, and our price target is suddenly 1784. So we're just going to draw a block there because we don't quite know where it's going to be, right? We could probably go back in time and look for DeMark or Williams, whatever support areas, and as we can see, we're in luck because there's one right over there, right? And there's another one there. And is there any more around this area? Okay, my chart doesn't go back far enough. So there we already have a support range, right? Which is quite a bit lower than what the target is that that Peter has given us, but it is the low of this thing, and it might even be, okay, I see he's got fib levels on here, but I don't know what he's measuring that, 0 to 100, and then down. Yeah, I don't know if I like this fib, but anyway, Oh, so you're saying bearish flag breakout, bounce on this zone and then up. Oh, so you're trading this bigger fib. Okay, that's a story for another day. I don't know if I trust that fib. It looks more like a range trade to me, so you might have your bounce and up, but I don't know if it's going to be because of the fib. It might be. I mean, I don't know. What people would want to see here is a head and shoulders. Eh? So everyone's going to say, oh, there's a head and shoulders. It's got to come down. No, it's not at the top of an uptrend. That could be a head and shoulders there, right? But because it's at the top of the uptrend, this could be a head and shoulders. Yeah, up, boom, boom, boom. That could be a head and shoulders, and it actually sort of plays out, right? But this is not, because right next to it there's a peak that's higher. So if there was a smaller formation in here, that was a head and shoulders. Sure, that could be a head and shoulders up here. Okay, this is just a sort of consolidating sort of distribution rounding top kind of situation, but definitely not head and shoulders here, here, and here. All right, and then last one, I'm gonna look for a few more charts. Okay, USD was Fed rates today. Oh yeah, it was Fed rates, and I'm monologuing on YouTube and missing all the fun. I'll thank you for that, Peter. Much appreciated. Okay, and I just want to quickly check here something else. Okay, sorry, I'm just checking for questions. All right, and then what do we have here? AUD CHF, Aussie dollar, and the Swiss franc, is it? Sure. Okay. What we got? You're looking from 1 December 2017. What am I looking at? Oh wow. Alright, so I've got dirtier data than you, unfortunately. Because I have a fair number of price spikes. So I'm gonna have to rely on your chart. 2013, 2015, 2018, 2019. Oh, right a minute. You starting from there. Okay. I got you. Alright, so unfortunately my chart looks a bit different. I've got these huge spikes here. That must be a data error, I'm guessing, on the side of the platform. I mean, if you look at a line chart, maybe that'll be a bit better. Bang. Alright, but it still has the low here, so it's not perfect. Alright, let's see what happens if I just manually make it fit. Alright, okay, that's gonna work for us. And we're gonna switch this back to a bar chart. Just ignore the low on this candle or bar. Alright, what do you got? You've got a rising wedge. Alright. Interesting. Let's have a look at what you have drawn here. So you've got that into that. Okay, so I'm gonna be a little critical, and I'm gonna say the following. Right, what you're doing here is you're ignoring this low because it fits your bias, right? I mean, you may well be right. This might go up, right? But you can't ignore that low just because it doesn't draw the picture you want to see. If that makes sense, right? So what I would rather do is draw. I would rather use that and that. Let's make the circle bigger. We're gonna do this 6 points. Bang. I'd rather draw in that, right? And then maybe draw in that. Is that gonna work? Are we connecting real bodies here? Let me switch to candles so that you guys can see, because I don't know if you can see the little stukas. So that could be slightly closer to it. for me at least, it's in the eye of the beholder at the end of the day. You could probably, so that does connect as a trend line, right? In fact, there's a huge, much bigger trend line coming down here. Okay, it's a little dirty because it intersects here. So we can't use that. We'll have to use that. And put our trend down, and that looks a lot better. Okay, so we obviously have a very, very clear downtrend here, right? That we don't really want to mess with because, you know, you don't mess with the Zohan. So you're looking for a counter trend move. I would wait until this orange trend line is broken. In the meantime, this is a flat bottom triangle, right? Okay, it's not drawn perfectly in here, but this is basically, to me, a flat bottom triangle is where you're seeing a wedge, because you're doing that, which, you know, I suppose could work, but then this low, you could see it was significant kind of level, even going back. So you can't like just ignore it because it's not, yeah. So I would draw that. I would draw that, and then that obviously has the wrong screen. That has the kind of like well, where's my symmetrical? Yeah. So we've got a bilateral pattern. So it could go either direction, basically. So your bullish view might be correct still, but overall my view here would be bearish on the basis of the trend over the last 12 months is down. But again, you know, eye of the analyst, it's not necessarily correct. I think everybody obviously has to find their own way. But that's kind of the way that I see it. All right, cool, guys. Thank you for joining. I think that is it. How long have I been going? Where's YouTube? Wow, hour and a half. Okay, so about an hour, 20 minutes. Okay, cool. I'm going to call it a night. Thank you very much for joining. Once again, I hope that you found this stuff helpful. If you have, subscribe. Use the bell for notification stuff. Join the Discord. Let's get some community going. It'll be a lot of fun. To, I don't know, chat with you guys every day. And at the moment we have 1 or 2 guys that are online a lot of the time, but not 1 or 2 guys, you know, it's just basically a handful of guys chatting, you know, maybe once a week kind of thing. So join, it's free, talk, whatever.